Hello and welcome to this week's special presentation. My name is Jim Penna, Manager of Retirement Services here at VectorVest, and I'm happy to be hosting this week's topic, which is titled 3 Keys to Building a Strong Dividend Growth Portfolio. Often, investors perceive dividend-paying stocks as a boring, low-return investment strategy, and when compared to the more aggressive investor who thrives on volatility, they may be right, as quality dividend-paying companies are generally more mature and predictable. I hope to show you in this presentation that a quality stock that rises in price with an increasing dividend payout can be successful and powerful enough to maybe get you excited about it. I'll start with our pyramid here for our dividend growth portfolio, and the 3 keys we're going to focus on here is first the quality, and by that we mean the quality of the underlying stock and more specifically its ability to sustain and grow a dividend payout. Next, we'll talk about diversification in your dividend growth portfolio, the need to be diversified not only in the amount of positions you hold, but in the industries and sectors that you are holding. And then finally, we'll talk about compounding and the power of compounding dividends over time and why you should look into the stocks you own and be sure that they have the DRIP plans or the dividend reinvestment plans available for you. So the first key to building your dividend growth portfolio is to find the highest quality dividend-paying companies. A common misconception for investors is that the measure of a good dividend stock is a high dividend yield. But because dividend yield equals the annual dividend per share paid divided by the share price, a higher yield may be the product of a falling share price. So does that falling price portend a dividend cut? Or worse? Well, the best way to avoid that scenario is to understand that the evidence of dividend strength is not found in the high yield, but rather the quality of the company, which can be found using the power of the VectorVest program. So let's go into the program and do some analysis. I'm going to go to the main toolbar and click on the Viewers tab. And here in the Viewers tab, I've input 5 different stocks here so that we can do a little bit of comparison shopping here. And of course, we'll always go through our main proprietary indicators of relative value, safety, timing, the CI as well. What I'm going to do for our purposes here in this presentation is focus more on earnings. All investors should realize that a company's dividend payments are no safer than its earnings performance. Dividends cannot be paid out of thin air. As Dr. DeLito has written in his book Stock Strategies and Common Sense, when he talks about earnings yield, eventually, dividend payouts must come from earnings. So let's take a look at the stocks we have listed here and do some comparison shopping. We'll start with earnings per share versus the dividend that the company pays. It's a quick look and logical to assume that if a company is paying out more in dividends than it's earning per share, then that might be a red flag that we have to consider. So we'll start here with Bank of the Ozarks right up on top. We see its earnings per share is at $3.37 per share, and currently the dividend payout is 76 cents per share. So we're comfortable in that the earnings per share is greater than the dividend they're paying out. Next is Taiwan Semiconductor. Also, earnings per share greater than the dividend payout. McDonald's, earnings over $7 a share, paying out just about $4 a share. And then we get to Oxy Petroleum, which is here in its earnings per share at $1.71 and a dividend payout of $3.08. And so there's that red flag that we're talking about, although we will dig deeper into companies like Occidental Petroleum. And then finally, CenturyLink, trading at about 17 and a quarter and showing an earnings per share of $1.19 and a dividend payout of $2.16. Earnings per share versus the dividend payout is a quick way to at least get that first insight into a company's ability to sustain their dividend and grow their dividend payout. Next is the earnings yield versus the dividend yield, and this is more important. Again, in Chapter 14, Dr. DeLito has written about using the earnings yield in several different ways, and there's a lot of vital information that can be found in the earnings yield, and one way to apply it is assessing dividend safety. And Dr. D refers to earnings yield as the kissing cousin of dividend yield. Since earnings yield reflects the amount of money a company is making, and the dividend yield reflects the amount of money being paid out to shareholders, earnings yield provides an ideal tool for assessing dividend safety. So it's simply a matter of comparing one to the other. And when we do that, we're able to come up with an important number to consider, and that is called the dividend payout ratio. So let's start with Bank of the Ozarks. I'm going to go ahead and bring our calculator on here and do some quick math. So if we look at Bank of the Ozarks and we look at the dividend yield, we're going to take the dividend yield of 1.48%. I'm going to divide that by the current earnings yield, and we'll then multiply by 100, and that will give us what's called the dividend payout ratio. In other words, Bank of the Ozarks is paying out, we'll call it 22.5% of their earnings yield in dividend payouts. Historically, when we look at dividend payout ratios, there's a lot of ways to calculate this. Using VectorVest, it's very easy to simply take the earnings yield and dividend yield. Very valuable information. Generally, what we're looking for is anywhere from 35 is usually the average up to maybe 50% as a company's dividend payout ratio being at a safe, normal ratio that we don't have to worry about too much. However, once that ratio crosses up above 50%, what we then have to worry about is a company's ability to sustain their dividend payout. If the headwinds start to go against them in the economy or something else specific to their company, if that payout ratio is too high, it sends that red flag that perhaps dividend cuts might be in the future. So Bank of the Ozarks at 22.5, and we can take a look at one more example just to show you how to calculate these. If we look at let's say we go down to Oxy and we look at their dividend yield of 4.08 and we divide that by their earnings yield, which is at this point 2.26. We multiply that by 100, we see that we have a 180% payout versus their earnings. Now, this would certainly raise a red flag. Now, when we compare that to something like CTL, here's what we begin to look at. We start to look deeper, and here the growth rate for Oxy here is at 33%. That's their earnings growth rate in percent per year. We could also have the ability to look at their dividend growth rate. If we scroll over just a bit, close that. If we scroll over just a bit, we can see their dividend growth rate is also in double digits. That's a strong dividend growth rate. But the company has poor relative safety. Now, the difference between companies like Occidental Petroleum and CenturyLink is that when we dig deeper into the balance sheet, we can see that the earnings growth rate is much stronger. The dividend growth rate has a much greater history, right? The history dividend of Oxy is much stronger. In fact, when we look back, we see a dividend history over the last almost 20 years, since 1999, that Oxy has increased their dividend every year since 1999. So while there is more to assessing dividend safety, earnings yield versus dividend yield is a really good place to start. Next, let's take a look at diversification. While owning a greater number of stocks can provide diversification benefits, many investors still end up with poorly diversified portfolios because they're drawn to a particular type of stock, whether it's an industry group or using investing rules that are too strict and don't allow for that diversification. And so we want to be sure that we're not buying stocks, even though we're in different industries. If those industries are similar, they are often sensitive to the same factors and move together in the market. In other words, they're highly correlated, even though they're in different industries. And so what we like to do is make sure that we're using sectors when we begin to diversify. So I'm going to go back into the program, and I'm going to go into the Unisearch tool here. So here in the retirement folder, we have the Blue Chip Dividend Payers search. This was introduced back in September of 2017 in one of our special presentations where we built a pretty basic search parameters. We used a sort of growth rate, earnings growth rate times dividend growth rate, looked for those mature, predictable stocks in the Dow Jones Industrials, Transport, Utilities, and the S&P 500. We wanted a dividend yield of at least 3% to start, and we used what we call our DRIP watch list. These are the Dividend Reinvestment Plan watch lists. These watch lists are made up of stocks that have not only paid but increased their dividends every year in the first category from anywhere from 10 to 24 years. And then we have a watch list for those stocks that have increased their dividends for 25 or more years. And so if we go ahead and run a search as of today, and we take a look, we break that down, and we'll slide over all the way to the right. When we talk about diversification, if I were to just go in and choose the top 10 blue chip dividend payers, I wouldn't be very well diversified because already I can see I've got 4 of the top 10 already in petroleum. I've got 3 utilities, and so I'm not comfortable with that diversification. So we have to be sure that we remain diversified. So one great way to do that is to go back to the main toolbar, and I'm going to choose the back tester. And what I've done here is I've run some back tests that we'll talk about a little bit. We can take a look at their performance here. I've got 2. This is just the blue chip dividend payers using confirmed calls. I just basically used 5 years ago as a window to run the test. 76% winning trades using some very basic money management techniques. We just use recommendation equals sell as our stop criteria here. We only did, I believe, 18 round trip trades plus the trades that are currently in. We have 10 holdings currently. 18.25% return, compounds at just under 14% with really not much drawdown over a 5-year span. And then I'll talk more about the second back test in a moment where I change the sort. But here we're using dividend growth rate times earnings growth rate as our sort. And if we take a look at the current holdings, when you start building your dividend growth portfolio using the back tester to run that test and then convert it into a portfolio, it's going to take care of the diversification for you instead of having you scroll through, which you can, and there aren't that many stocks that are going to fit the bill anyway, but you can come to the back tester and set up your criteria. But you've got financial, drug, aerospace, so we're not overweighted in any one sector here. So if any one sector were to take a hit, this is the true definition, I believe, of being more diversified. Now, we are using 10 positions here in our theoretical $100,000 portfolio. You certainly could up that number of positions to diversify even more. In a dividend portfolio, anywhere even up to 15 or 20 stocks would be fine to do as well. So from that back test, we can see that I've got our current holdings in watch list form, and we take a look at that information. So again, we're looking for earnings yield greater than the dividend yield. And each of the stocks here are clearly showing that dividend payout ratio to be favorable for us. So we're diversified. We've got the quality and sustainability of that dividend, even though some of our growth rates aren't great here. But again, these companies have been paying and increasing their dividends for at least the last 10 years, some as many as 40, 50 years or more. If I bring this back down just to show you what I've done here, I've simply taken the search that's already built into the program in the Unisearch tool, again known as blue chip dividend payers, and just out of curiosity, I created a search. You won't see this search in your program, but I created a search called blue chip dividend payers, and I changed the sort. I created a custom sort by going to the Tools tab, Custom Field Builder, and I chose the field name of earnings yield, and I chose earnings yield divided by dividend yield. So that's the name of the field. We put in EY divided by DY. I'll need to validate that. The custom field is validated. I'll click OK. Save changes. Now I already put it in, so that's why it's telling me it exists. I'll just say OK, and we'll exit out. And so let's take a look at the stocks that come up here when I change the sort. So here, the stock has to meet the criteria here, but is sorted by that vital tool that allows us to assess dividend safety. So we want to be sure earnings yield is greater than dividend yield. As I scroll over and we take a look at the numbers, if I go ahead and slide earnings yield over next to the dividend yield, we'll see the dividend yield on IBM at 3.7 versus an earnings yield of 8.57. And so on down the line. So we've got that favorable number on earnings yield versus dividend yield. And so it brings to the top stocks with a very favorable payout ratio. Also, the stocks up here all have nice dividend growth rates as well, all double digits in the top 10 or so. So if I go back to the back tester, you can see the results that came here. We did do better with our 5-year back test than we did on the original blue chip dividend payers, although we did very well on each. Blue chip dividend payers using the EY divided by DY sort did a bit better. We did a few extra trades here. Drawdown roughly the same, so pretty good return here over a 5-year stretch. And I realize the market has gone up, and that's a nice return in a rising market. And keep in mind that neither of these returns here take into account the dividends paid. Now, on the blue chip dividend payers, I have gone back in other portfolios and manually calculated the dividends and can tell you it's roughly about $25,000 here. So if you add that up, add another roughly 25%, if we're rounding, to each of these returns. And so you've got some pretty good returns when you begin to add the dividends paid to these results. This is just capital appreciation that we're looking at here. Which leads me to our final key to consider when building your dividend growth portfolio. And that is that if the circumstances allow, I strongly urge to take advantage of the power of compounding. So if we quickly go back into the program, once again, this does not include the dividends. Again, roughly 25%, roughly $25,000 worth of dividends would have been paid out over this time frame. Even that number does not take into account the power of compounding those dividends over that time frame. So we can just take a quick look at the power of dividend growth, and here the green line is representing the portfolio that reinvests 4% growth dividends, so that over time you can see that $1,000 is worth over $9,000 over a period of years, and you can see how the arc begins to rise. If you go in and collect dividends, and even if those dividends are zero growth, as long as you're compounding and reinvesting them, you've got a nice upward movement. And then finally, if you're not reinvesting those dividends, that portfolio will grow, but certainly not at the rate that the portfolios that reinvest do. And I've created a spreadsheet here. It's a little crowded, but let me walk through it. RSG is a company that is in the current blue chip dividend payer model portfolio that we track. When we look at the compounding value of quarterly dividend reinvestments, I've rounded the purchase to 500 shares. It's a little different in the portfolio, but for this purpose I've rounded it to 500 shares. On September the 11th of 2012, we bought 500 shares at $28.22. And what this spreadsheet shows is that the first dividend payout after that purchase was on September 27th of 2012. That date, the stock closed at $27.33. That's the price we'll use. It paid 24 cents quarterly payout, RSG did. And on that day, owning 500 shares, I would have gotten a dividend payday of $120. Now, if I use the dividend reinvestment plan, which I can go through my broker to set up, where they automatically reinvest the dividend paid and allows you to buy fractional shares, I would have gone out that day and at $27.33 per share would have added 4.39 shares to my 500 shares. Now again, you can do this through the company, you can do it through your broker. There are some fees involved. They're excluded for our purposes here, but 504.39 would have been my share amount as of that date. The next dividend pay date was 3 months later in December of 2012. On that date, $29.01 was the price of the underlying stock. That was $121.05 of dividend, allowed me to add another 4+ shares to my holding. And so you get the picture here. As we go through each dividend payout, instead of collecting those dividends, I reinvested them, and right up to 12/29 of 2017, which was the last dividend payout, the stock closed at $67.61. And we can see a dividend that over that time frame has grown from 24 cents quarterly payout up to 35 cents quarterly payout currently. So that total dividends added up to $3,415. And down here we just put in some quick numbers here. Return on investment for this particular trade, not including dividends. If the stock didn't pay dividends at all, you'd still have a nice trade. You're up 139% because we found a good quality stock using the VectorVest system. Return on investment using dividends but not reinvesting them, our total as of the 29th of December would have been $23,555. That's a 164% return. So you can see the difference in that return. And then finally, using these calculations, return on investment with dividends reinvested, you had a 177% gain, or $25,000 on the overall return. So again, we started with 500 shares. 5 years later, we have 578.82 shares. And we can see how the value of our position has grown over that time. This is one position over a 5-year period. So for the concept we're talking about is a relatively short time. Picture a portfolio of 10, 15, maybe 20 stocks over a 10 or 12 or 15-year period. And you can calculate the power of these compounding dividends in your dividend growth portfolio. So to summarize, the 3 keys to building a strong dividend growth portfolio: remember, focus on the quality of the company over the highest yields. Don't just chase the high yields. The company has to be able to sustain and grow those dividend payouts. And remember, they all come from earnings. Diversify your portfolio. We like to say use no more than 2 stocks per sector. If you've got 15 or 20 stocks in your portfolio, you may grow that number to maybe 3 stocks. Or if for 20 stocks, you may use 4 stocks per sector. But I'd rather have you use the stocks per sector than the industry. And finally, again, if the situation allows it, take advantage of the power of compounding using the dividend reinvestment plans. Some folks will actually take that dividend payout and they'll use it to go on vacation, to pay bills, to give to their grandkids, whatever it might be. But I strongly urge you to look into the stocks that you own or that you put into your portfolio, check with your broker, and it's very easy to sign up for those dividend reinvestment plans. And that concludes this special presentation. As always, if there's anything we can do to assist, 888-658-7638 is our number, and I thank you for taking the time.